What if I told you that moving from a low-cost town in Ohio to, like, a beachfront property in California might actually be the absolute worst financial decision a psychiatric provider could make in 2026?
I mean, it sounds completely counterintuitive when you look at the coastal salaries, but when you run the actual math on modern healthcare economics, staying put might literally be the key to unlocking a massive financial windfall.
And that is exactly what we are getting into today. Welcome to the Deep Dive. Today, we are looking at a newly released market report and a comprehensive guide from the PsycNP Fellowship. It was spearheaded by Lindsay Hill and her team.
Right, and it's a fantastic resource.
It really is. They've basically mapped out the entire 2026 landscape for psychiatric mental health nurse practitioners, or PMHNPs. But, we aren't just going to rattle off a list of salaries like some audio spreadsheet.
No, nobody wants to listen to that.
Exactly. The mission today for you, our listener, is to uncover the specific, sometimes hidden levers that dictate those numbers. We're talking geography, practice settings, negotiation traps, and the sheer business acumen required to swing your earning potential by tens of thousands of dollars.
Because the landscape has fundamentally shifted. We are looking at what happens when an entire medical sector violently transitions into a permanent seller's market.
Yeah.
But having leverage is basically useless if you don't understand the mechanisms behind it. If you walk into a negotiation just, asking for more money without understanding the macroeconomic forces pushing that clinic's bottom line, you're leaving an enormous amount of capital on the table.
Okay, let's unpack this because the foundational numbers here are just wild. According to the report, the PMHNP market in 2026 is seeing a 3-to-1 ratio in most metropolitan areas.
Right.
That means for every one qualified candidate, there are 3 open positions. It's like a game of reverse musical chairs. When the music stops, there are 3 empty chairs physically fighting over you, begging you to sit down.
What's fascinating here is the collision of 2 massive systemic trends, because this isn't just a temporary hangover from the pandemic.
Right, it's deeper than that.
Much deeper. On one side, we have a profound, long-standing national shortage of psychiatric providers. Medical schools and nursing programs simply haven't scaled fast enough to replace retiring practitioners.
And on the other side?
Well, on the other side, we've seen a permanent structural shift in mental health utilization. The stigma has largely dissolved, and accessibility has increased. So you have a flat supply line crossing paths with an absolutely vertical demand curve.
And when that happens, the price goes up. The report shows the average employed PMHNP salary nationally has hit roughly $155,000.
Yeah.
And from what I'm reading, employers are basically throwing everything they can at these candidates just to get them in the door.
They really don't have a choice. When a clinic has a 3-month waiting list of patients who, by the way, represent guaranteed revenue, every single day a provider chair sits empty, the clinic is actively bleeding money.
Oh, well.
Yeah, that 3-to-1 candidate shortage translates directly into very aggressive, comprehensive compensation packages. We're seeing sign-on bonuses routinely hitting anywhere from $5,000 to $25,000.
Just sign the paper.
Exactly. And on top of that, they're offering robust student loan repayment assistance, dedicated budgets for continuing medical education, and highly flexible scheduling.
But, a national average of $155,000 is still just an average. It smooths out all the regional disparities.
It does.
Let's talk about the map, because geography seems to be one of the heaviest variables in this whole equation. The West Coast is leading the pack, right? The report shows salaries there hitting between $175,000 and $200,000.
That's right. The Northeast corridor follows closely behind at $160,000 to $185,000, and then the Pacific Northwest is offering $155,000 to $180,000.
But surely that's just because cities like San Francisco, Seattle, and New York are incredibly expensive, right? How much of that $200,000 actually goes into a provider's pocket compared to someone working in, say, the Midwest?
That is the big question.
Right, because the report lists the Southeast and the Midwest coming in significantly lower, around $130,000 to $155,000.
And that cost of living discrepancy is the exact wedge that savvy practitioners are using to their advantage. A base salary of $130,000 in a low-cost Midwestern city might actually offer a much better quality of life than $180,000 in Los Angeles.
That makes total sense.
But it's not just about the region, it's the setting within that region. Community mental health centers, for instance, generally sit at the lower end of the pay spectrum, offering $120,000 to $145,000.
But wait, The report mentions something called the NHSC loan repayment for those community roles. How does that actually function? Is it just a tiny stipend, or is it a game changer for someone's net worth?
Oh, it can be a massive wealth accelerator. The National Health Service Corps allows providers who commit to working in underserved areas, which are often those community mental health centers, to have tens of thousands of dollars of student loan debt forgiven.
Oh,
And crucially, it's often tax-free. So while your base salary might look lower on paper, wiping out $50,000 of debt over 2 years completely changes your financial trajectory.
yeah, it is a huge deal. You're basically trading a high base salary for massive debt relief.
Exactly.
And then on the other end of the setting spectrum, you have hospital roles offering 140 to 170,000, and private group practices pushing up to 185,000.
Which brings us back to your opening thought about the Ohio versus California dilemma.
Right. So if I live in a low-cost area in the Midwest, where the local ceiling is maybe $140,000, why wouldn't I just take a remote telehealth job based out of a clinic on the West Coast, make $190,000, and pocket the massive difference while keeping my cheap Ohio mortgage?
You absolutely can. And it's a structural strategy called geographic arbitrage. The rapid expansion of telehealth has fundamentally decoupled where a provider lives from where they generate revenue.
Wait, I need you to pause there, because licensing has always been the nightmare hurdle in medicine. Can you just legally treat a patient in California from your living room in Ohio? How does the bureaucracy even allow that?
It requires strategic licensing, but the landscape is shifting rapidly to accommodate this. A major catalyst is the Nurse Licensure Compact, specifically for states that include Advanced Practice Registered Nurse, or APRN, provisions. This creates a multi-state license, almost like a driver's license, where you are recognized across participating borders. But the real linchpin to making geographic arbitrage work isn't just the compact, it's understanding full practice authority.
I saw that term heavily emphasized in the report.
Yeah.
But help me connect the dots here. If I'm fully licensed as a PMHNP in a state with restricted practice, why does having a collaborating physician actually lower my paycheck? I'm doing all the clinical work with the patient, aren't I?
You are, but the clinic's overhead is entirely different. In restricted practice states, the law requires a psychiatrist to oversee or collaborate on your work.
Right.
And that psychiatrist doesn't work for free. Their time, their liability, and their administrative oversight cost the clinic a premium. In full practice authority states, PMHNPs can evaluate, diagnose, and prescribe completely independently.
Ah, so you generate the exact same revenue for the clinic, but without that built-in physician oversight tax dragging down the profit margin.
Exactly that. Because the clinic's overhead on your labor is lower, your direct value to the bottom line is higher. That leads to aggressive recruitment and significantly higher pay. States in the Midwest and South that recently adopted full practice authority are seeing an explosion in salaries for this precise reason.
So locating the money geographically and structurally is really only half the battle. You can find the treasure map, but you still have to extract the gold when you sit down at the negotiating table.
That's the hard part.
Yeah, and from what I'm reading, the 2026 negotiation playbook is ruthless. The report is very clear. Your ultimate leverage is having competing offers.
It's the only leverage that truly forces a clinic's hand. The guide advises applying to multiple positions simultaneously and intentionally overlapping your decision timelines.
What I love about this advice is that you shouldn't hide it. I mean, it feels rude to tell an employer you're shopping around, but the report says they fully expect it.
They do.
If they know you have another clinic drafting an offer, they will speed up their internal hiring bureaucracy so they don't lose you.
It's just business. And when you do get to the numbers, you have to look beyond the base salary. Experienced PMHNPs should be demanding comprehensive packages.
Like what?
We're talking standard signing bonuses in the $10,000 to $25,000 range. You negotiate student loan repayments of $5,000 to $10,000 annually directly from the employer. You ask for CME budgets of $2,000 to $5,000 a year. You negotiate extra paid time off and guaranteed remote work days.
Here's where it gets really interesting, because the report flashes a giant red warning light about a specific trap when negotiating private group practice roles.
Yes, the productivity trap.
Right. They tempt candidates with these massive productivity bonuses based on RVUs. Let's pause on RVUs for a second, because that acronym gets thrown around a lot in medical billing.
Yeah.
What is the actual math behind a relative value unit?
Basically, an RVU is a metric used by Medicare and insurance companies to determine how much a specific medical visit is worth. It calculates the time, the clinical complexity, and the overhead required to treat a patient. So a quick 15-minute medication check might generate a fraction of an RVU, while an intense, hour-long initial psychiatric evaluation generates several.
So productivity bonus sounds great on paper. The clinic says, hit this number of RVUs per month and we give you an extra $20,000 a year. But how do you know if you're stepping into a trap where those targets are mathematically impossible to hit?
That is the exact trap. A productivity bonus is completely worthless if the clinic's internal operations are a mess.
What do you mean by a mess?
Well, if their scheduling system is terrible, or if the front desk isn't calling to confirm appointments and the patient no-show rate is incredibly high, you suffer. You could be sitting in your office totally ready to work, but if the patient isn't in the chair, you aren't generating an RVU.
Imagine the psychological toll of that. You're ready to churn through 20 patients a day, giving it your absolute all, but because the clinic's front desk system is broken and patients aren't showing up, your paycheck is shrinking.
It's so frustrating.
That is a fast track to severe burnout. You're basically penalized for someone else's incompetence.
Which is why the report offers a pretty brilliant defensive play. First, you demand historical data during the interview. You ask them point blank, what percentage of your current providers actually hit this RVU target last year?
Oh, I love that.
Right. If they hesitate or refuse to tell you, you walk away. That is a massive red flag.
And what's the second defensive move?
You demand a guaranteed base salary for the first 12 months, regardless of RVUs. You need that financial runway to build up a reliable patient panel before the productivity targets actually kick in.
That makes sense.
Yeah, if the clinic truly believes in the ability to supply you with patients, they should easily agree to that buffer.
That is such a smart, tactical approach. Now, if the idea of fighting with a hospital administrator over RVU targets and paid time off sounds completely exhausting, there is another path. You can bypass the employer entirely and go into solo private practice.
True.
The gross revenue ceiling is undeniably higher, but is it actually as lucrative as it looks on social media?
Well, the gross revenue ceiling is staggering. A solo private practice operating at full capacity, which is generally considered 25 to 35 patients a week, can generate $200,000 to $350,000 in gross revenue. But, gross revenue is an illusion.
Right, it's like looking at the gross revenue of a busy, trendy restaurant. $300,000 sounds amazing until you realize you're the one buying the ingredients, paying the rent, replacing the broken ovens, and paying the staff out of that exact same pot of money.
If we connect this to the bigger picture, the actual net income for a private practice usually lands between $150,000 and $250,000. The absolute biggest differentiator between those two numbers is your overhead.
How so?
If you run an entirely telehealth-based practice, your overhead might only be 10 to 15%. You're paying for a HIPAA-compliant Zoom account, an electronic health record system, and some digital marketing. But if you lease physical office space in a nice part of town, your overhead instantly jumps to 25 to 35% of your gross revenue.
And then there are the hidden structural costs. This is what I think the report really nails. When you are employed by a hospital, you get a paycheck, but you also get this invisible shield of benefits. When you are the boss, you have to fund that shield yourself.
That invisible shield is incredibly expensive. You have to self-fund your health insurance, which can easily run $6,000 to $18,000 a year, depending on your family size. You have to buy your own malpractice insurance, which is another $2,000 to $5,000. There's no hospital matching your 401k contributions.
And let's talk about the math of a vacation, because paid time off just doesn't exist when you're the owner.
It's a double financial hit. If you take a 2-week vacation to recharge, you obviously aren't billing patients, so your revenue drops to zero for those 2 weeks. But your overhead expenses, your software subscriptions, your office lease, your marketing, those bills still come due. You are literally paying for the privilege of not working.
Which brings us to what I found to be the ultimate clarifying metric from the PsycNP Fellowship Report. They did the hard math on all of this, and a private practice that is netting $200,000 is roughly equivalent in actual lifestyle value to an employed job making between $165,000 and $175,000 with full benefits.
It is a sobering calculation. Private practice offers unparalleled clinical autonomy. You dictate your schedule, you choose your patient population, and the ceiling is yours to break. But it transfers 100% of the operational and financial risk directly onto your shoulders.
Okay, so whether you choose the safety net of employment or the high-risk, high-reward ceiling of private practice. Are there universal ways to just break past these salary averages entirely? Like, how do you get to the absolute top tier of this profession where you're commanding the best rates?
You have to specialize and you have to understand the business. The report points out that while there is a general shortage of psychiatric providers, there are acute, severe shortages in specific subspecialties. We were talking about child and adolescent psychiatry, addiction psychiatry, and geriatric psychiatry.
So the 3-to-1 ratio for a general practitioner might actually be a 10-to-1 ratio for someone who specializes in geriatric psych.
Exactly. If you hold additional certifications or have deep, documented clinical experience in these specific niches, you instantly command a 10 to 20% salary premium over the baseline.
Wow.
You also build leverage by establishing a reputation outside the clinic, precepting students, doing clinical writing or speaking at conferences. Even a single published article signals to an employer that you are a thought leader, not just another employee.
But the report hints that the most critical factor, the thing that separates the solid earners from the absolute top tier, is business acumen. So what does this all mean? It means that for you, listening right now, being a phenomenal clinician is only half the job. Understanding the actual mechanics of the healthcare business is what makes you indispensable.
Whether you are an employee trying to prove to a hospital board why you deserve a $25,000 raise, or you are a solo practitioner trying to keep your telehealth overhead under 15%, you have to understand the math. You need to master revenue cycle management.
Let's define that, because revenue cycle management, or RCM, isn't just sending a bill, right?
Not at all. It's the entire life cycle of a claim. It's a difference between seeing a patient and actually getting the insurance company to release the funds 45 days later without kicking back your billing code because you missed a specific modifier.
Oh, bureaucracy.
It's intense. If you don't understand how billing codes dictate reimbursements, you will routinely leave thousands of dollars of legally earned money in the insurance company's bank account instead of your own. Adding basic organizational finance and coding knowledge to your clinical expertise is the highest return investment you can make in your career.
It is the literal difference between knowing how to do the work and knowing what the work is actually worth in the marketplace. Let's recap this journey we've been on. We started by looking at a massive macroeconomic advantage, the 3-to-1 candidate shortage that has driven average salaries to $155,000.
Right.
We looked at how to play the geographic arbitrage game, using telehealth and full practice authority states to earn West Coast money while keeping a Midwest cost of living.
We covered the necessity of the 2026 negotiation playbook, leveraging overlapping timelines to secure robust sign-on bonuses and demanding guaranteed base salaries to protect yourself against the psychological burnout of the RVU trap.
We did the hard math on private practice, comparing the gross revenue illusion of the restaurant to the out-the-door reality of self-funding your own invisible shield of benefits. And finally, we looked at how specializing in high-need populations and mastering the actual life cycle of an insurance claim shatters the salary ceiling entirely. It is a massive amount of leverage.
It is an incredible amount of leverage right now. But this raises an important question, something tucked away near the end of the source material that we really need to think about. The report notes that the APRN Compact, that multi-state licensing agreement that makes geographic arbitrage so lucrative, is currently just 2 states away from activating on a much broader national scale.
Wait, so what happens to this localized data when those final 2 states sign on and the map basically opens up?
That is the multi-million-dollar question. If multi-state licensing becomes nearly universal across the country and telehealth continues to keep overhead at a mere 10 to 15%, what happens to all these regional salary disparities?
That's a great point.
Right now, geographic arbitrage is a clever hack for an Ohio PMHNP to earn a California salary. But if state borders effectively dissolve in the virtual space, will that cause national salaries to completely flatten out? Will the high West Coast salaries drop as cheaper labor floods the virtual market from the Midwest? Or will the Midwest salaries rise to meet the coastal demand?
Wow. It's the ultimate consequence of remote work applied to high-level medicine. The physical map suddenly stops mattering. That is a fascinating thing to ponder as the healthcare landscape hurtles toward this borderless future. It really makes you wonder who will be holding the strongest cards at that mahogany table 5 years from now.
It absolutely does change the game entirely.
Well, thank you for joining us on this deep dive. We hope it gave you some powerful tools, a deeper understanding of the mechanics behind the math, and fresh perspectives to take with you Keep questioning the data. Keep looking for those hidden levers. And remember, when the music stops, make sure you know exactly how the mechanics of that chair work before you sit down.